In 2026, the United States faces an unprecedented financial challenge. The national debt, once a distant issue, now looms over the nation, threatening to disrupt the economy and global financial stability. As of 2023, the U.S. national debt has exceeded $32 trillion, and projections suggest it could surpass $35 trillion by 2026. The question on everyone's mind: how did America reach this point, and what lies ahead for the economy, the global financial system, and the average American? The debt grows faster than the economy, and even the most optimistic forecasts do not predict an easy recovery. The nation must grapple with this mounting burden. But how? To understand the trajectory of America's national debt, we must first look at its historical rise. The U.S. debt started becoming a significant issue in the 1980s. However, it wasn't until the late 1990s that the debt really began to accelerate. After the 2008 financial crisis, the situation worsened as the government increased borrowing to stabilize the economy. The primary drivers of this growth in debt were military spending, the expansion of entitlement programs such as Social Security and Medicare, and the costs associated with past borrowings. Each increase in the debt was followed by political and economic debates about its consequences. In 2011, the U.S. government implemented the debt ceiling law, which was meant to limit the maximum amount the government could borrow. Despite this, the debt continued to rise, and by 2017, the debt surpassed $20 trillion. Much of this increase was due to not only rising expenditures but also tax cuts, which decreased government revenues without offsetting reductions in the deficit. By 2023, the U.S. national debt exceeded $32 trillion, translating to roughly $250,000 per American family. The primary factors contributing to this debt are large social programs, such as Medicare and Social Security, as well as military spending, which accounts for a significant portion of federal spending. Over the past 20 years, the federal budget deficit has averaged around $1 trillion per year. Additionally, the cost of servicing the national debt is rising rapidly. In 2023, the U.S. spent approximately $400 billion just on interest payments. This amount is expected to nearly double by 2026, with projected payments surpassing $900 billion annually. The debt-to-GDP ratio, an important indicator of national financial health, is expected to exceed 130% in 2026, marking one of the highest levels in modern history. This means that the U.S. owes more than it produces in a year, a dangerous signal that could undermine confidence in U.S. Treasury bonds, historically considered a safe investment. For decades, the U.S. has been walking a tightrope, gradually sinking deeper into debt. By 2026, with rising interest rates, escalating entitlement costs, and a growing debt-to-GDP ratio, the nation will face difficult economic challenges that demand immediate action. The real question is not just how big the debt is, but how it will be managed without plunging the nation further into crisis. Addressing the debt while fostering economic growth requires a comprehensive overhaul of fiscal policies, balancing short-term needs with long-term financial stability. In order to understand why America's national debt has grown to its current levels and is projected to keep rising, we need to look at the core factors driving its expansion. What's fueling this financial fire? And why does the national debt seem to be growing uncontrollably? From military expenditures to entitlement programs and tax policies, the national debt isn't just a byproduct of one or two economic factors. It's the result of a complex combination of spending habits, policy decisions, and demographic changes that have compounded over the years. The question is, can the U.S. continue on this trajectory, or are we reaching a tipping point? The growth of America's national debt isn't due to a single factor, but rather a combination of systemic issues. The U.S. government has consistently spent more than it brings in through taxes, leading to a growing deficit year after year. But several major categories of spending have played pivotal roles in this increase. One of the largest contributors to the national debt is military spending. The U.S. maintains the largest military budget in the world, with expenditures reaching nearly $800 billion annually in recent years. These funds are used not only for national defense, but also for overseas military operations, including wars and military presence in various global hotspots. Another major driver of debt growth is entitlement programs, particularly Social Security and Medicare. As the population ages, more Americans are entering retirement, requiring more funds for these programs. Social Security and Medicare alone accounted for about 40% of federal spending in 2023, and that number is expected to rise as the baby boomer generation continues to retire. Tax policies have also contributed to the increase in national debt. In recent decades, tax cuts, particularly those implemented during the George W. Bush and Donald Trump administrations, have reduced government revenues. While these tax cuts were designed to stimulate economic growth, they have also led to a widening budget deficit, as the government continues to spend at high levels without enough income from taxes to cover the cost. As of 2023, military spending accounts for nearly 15% of the U.S. federal budget, making it one of the largest expenditures in the national budget. The U.S. spends more on defense than the next 10 countries combined. The cost of maintaining military operations across the globe, as well as research and development of new technologies, contributes to this significant burden on the budget. Entitlement programs like Social Security and Medicare are projected to consume an even greater share of the federal budget in the coming years. By 2026, these programs will account for almost 50% of federal spending, driven by the aging baby boomer generation. Social Security alone pays out over $1 trillion annually, with more than 60 million people receiving benefits. Medicare, which provides health coverage to Americans 65 and older, is similarly facing increasing pressure as healthcare costs rise and more people qualify for benefits. On the tax side, the Tax Cuts and Jobs Act of 2017 significantly lowered the corporate tax rate and provided individual tax cuts that reduced revenue for the government. In 2023, the U.S. collected only 16% of its GDP in federal taxes, lower than the historical average of about 18%. This gap between revenue and spending has contributed directly to the rising national debt. The continued rise in America's national debt is driven by a combination of high military spending, escalating entitlement costs, and tax cuts that reduce government revenues. These factors have led to an unsustainable fiscal path, with federal spending consistently outpacing revenues. While some of these expenditures, such as military spending and entitlement programs, are essential to the functioning of the government, their growth without adequate revenue generation is a significant contributor to the rising debt. In order to address the national debt, the U.S. must confront these structural issues, either by cutting spending, increasing revenues, or both, a difficult balancing act that will define the nation's financial future. As the United States faces the reality of a $35 trillion national debt by 2026, what does the future hold? The consequences of rising debt will soon be felt across the economy, affecting everything from government spending to global economic stability. For the average American, it could mean higher taxes, fewer services, and an economy grappling with a debt burden that could potentially slow growth. But where exactly will the pressure points be in 2026? Will the U.S. be able to navigate through these challenges, or is a major economic reckoning inevitable? The projections for 2026 are sobering. If current trends continue, the national debt will exceed $35 trillion by that year, with debt servicing alone consuming an ever-increasing portion of the federal budget. Interest payments will rise sharply, primarily due to higher interest rates and the increasing size of the debt. The government will face critical choices: cut spending, increase taxes, or borrow more to keep up with obligations. Each option has its risks and consequences, and none will be easy. The U.S. will likely see higher taxes in the near future. With growing debt, the government will need to generate more revenue. This could come in the form of increased taxes on businesses, the wealthy, and potentially middle-class Americans. While tax hikes may be politically unpalatable, they are seen as necessary by many economists to close the growing revenue gap. However, raising taxes can also slow economic growth, as higher taxes on businesses could deter investment and innovation. At the same time, government spending will be under intense scrutiny. Programs like Social Security, Medicare, and defense are the largest components of the federal budget, but they are also the hardest to reduce. Cuts to defense spending would face strong political opposition, and reforming entitlement programs is politically challenging, especially given the aging population that relies on them. Without substantial reforms, these programs will continue to consume an unsustainable portion of the budget, driving the debt higher. In the global arena, the US dollar's role as the world's reserve currency is also at risk. If global confidence in the US economy falters, there could be a shift toward other currencies, like the euro or the Chinese yuan. This would further increase borrowing costs for the US and lead to a devaluation of the dollar, which could trigger inflation and make the US even more reliant on borrowing. The national debt is projected to grow by an average of $1.5 trillion annually, reaching $35 trillion by 2026. Interest payments on the debt are expected to surpass $900 billion annually, making it one of the largest expenditures in the federal budget. In 2026, it is anticipated that the U.S. will spend nearly 10% of its GDP on debt interest alone. The debt-to-GDP ratio is expected to exceed 130% by 2026, a level not seen since the aftermath of World War II. This is a critical threshold, as it suggests that the U.S. is borrowing more than it can generate through economic activity. Economists warn that such high levels of debt could lead to higher borrowing costs, loss of investor confidence, and reduced government flexibility in times of economic downturn. The U.S. tax rate is expected to rise to address the growing deficit. Under current projections, federal tax receipts will need to increase significantly to cover the rising cost of debt servicing and entitlement programs. The tax reform measures put in place in the past few years have contributed to a reduction in government revenues, and with the debt continuing to grow, higher taxes may be inevitable. Looking ahead to 2026, the U.S. faces a precarious financial situation. The country is on track to surpass $35 trillion in national debt, with debt servicing costs consuming an ever larger share of the federal budget. At the same time, global dynamics are shifting, and the U.S. could face a decline in the dollar's status as the world's reserve currency. To address these challenges, the U.S. will have to make tough choices. Tax hikes and spending cuts will be necessary, but these measures come with significant risks. Without meaningful reform, the U.S. faces a future of economic stagnation, higher borrowing costs, and a weaker position in the global economy. 2026 will be a pivotal year, and the decisions made now will determine the nation's financial future. As the U.S. barrels toward 2026 with an ever-growing national debt, the risks associated with this massive fiscal burden are becoming impossible to ignore. But amidst the looming threat of economic crisis, there are also glimmers of opportunity if the right measures are taken. Will the country sink under the weight of its financial obligations, or can strategic changes turn the tide? The stakes are incredibly high, and the next few years could make or break the future of the American economy. So, what are the risks and opportunities that lie ahead? The risks tied to a growing national debt are clear: escalating interest payments, a potential loss of investor confidence, and the inability to sustain critical government programs. However, there are also opportunities, particularly if the U.S. can navigate the shifting global economic landscape. The risk lies in how the government chooses to deal with its growing debt burden. If policymakers opt to raise taxes significantly or slash social programs drastically, they risk stifling economic growth and causing social unrest. On the other hand, a more balanced approach that encourages innovation, cuts inefficiency, and implements long-term fiscal reforms could present opportunities to stabilize the economy and even foster growth. The key lies in understanding the dual nature of the debt issue. While it certainly poses a threat, it can also be managed in a way that prevents a financial collapse. The challenge for the U.S. government will be to find this balance, which will require bold action and possibly unpopular decisions. The interest payments on the national debt are set to become a major concern in 2026. Projections show that the U.S. will spend nearly $900 billion annually just to service its debt, an amount that is expected to increase as the debt grows. This could force the government to make difficult choices, such as cutting spending on domestic programs or raising taxes to keep pace with debt servicing costs. One of the major risks associated with a growing national debt is the possibility of a credit downgrade. If investors lose confidence in the U.S. ability to meet its debt obligations, they may demand higher interest rates or even shift away from U.S. treasuries, which are traditionally seen as the safest investment in the world. A credit downgrade could lead to higher borrowing costs, further compounding the debt issue. However, there are also opportunities that come with the U.S. debt situation. The country's economic resilience has proven robust over time, even in the face of mounting debt. If the government can implement smart fiscal policies, such as investing in innovation, reducing inefficiencies, and refocusing on sectors that drive growth like technology and renewable energy, the national debt could be managed more effectively. Furthermore, the global demand for U.S. Treasury bonds remains high, largely because of the size and stability of the U.S. economy. While there is a risk that global investors may look elsewhere, the U.S. remains one of the largest and most liquid economies in the world. This gives the country an edge in managing its debt, at least for the time being. The key will be how long the world remains willing to lend to the U.S. at current rates. The risks associated with the U.S. national debt are significant, from rising interest payments and potential credit downgrades to social unrest from drastic cuts. However, opportunities remain. By implementing strategic fiscal policies, investing in growth sectors, and addressing inefficiencies, the U.S. can potentially navigate the debt crisis while still fostering economic stability and even growth. In 2026, the country will face critical decisions about how to manage its financial future. While the risks are high, the U.S. remains in a strong position to mitigate them if it acts with foresight and caution. The path ahead will require a balance of caution and boldness, ensuring the nation does not falter under the weight of its financial obligations. As the United States hurdles toward 2026, with a national debt exceeding $35 trillion, the question is no longer if something must be done, but what should be done to restore fiscal health. The time for small adjustments has passed. With interest payments on the debt consuming more of the federal budget and the threat of rising inflation and economic stagnation, looming large, decisive action is required. But what measures can ensure that the U.S. remains economically viable without suffocating growth or exacerbating social inequality? Is there a way forward that balances fiscal responsibility with economic growth? To address the national debt crisis, the U.S. must focus on a combination of strategies, reducing spending, reforming entitlement programs, enhancing revenue generation through tax reform, and investing in economic growth, without addressing the underlying factors driving the national debt, such as military spending, entitlement programs, and the inability to raise sufficient revenues. The U.S. risks spiraling further into debt and diminishing its global economic standing. The key to moving forward will be to make difficult political and economic decisions. Reducing the deficit will likely require both tax increases and spending cuts. However, spending cuts need to be targeted and smart. Cutting social programs for the elderly, for example, would exacerbate the country's demographic challenges. On the other hand, tax increases must be done in a way that does not stifle economic growth or reduce consumer confidence. The U.S. will need to identify areas of inefficiency in its spending, reform entitlement programs, and focus on investments that will drive future economic growth, particularly in industries that are poised for rapid expansion, like clean energy and technology. To begin addressing the debt, spending reforms are essential. Programs like Social Security and Medicare account for more than 40% of the federal budget, and this share is only growing. As the baby boomer generation continues to retire, the costs associated with these programs will escalate. By 2026, the U.S. is expected to spend nearly half of its budget on entitlements alone. Significant reforms to these programs, such as adjusting the retirement age, means testing benefits, or reducing Medicare spending, will be necessary to rein in these costs. In addition to spending cuts, tax reform will be crucial. The U.S. currently collects less than 17% of GDP in federal revenue, which is below the historical average of around 18%. To generate sufficient revenue, the U.S. will likely need to raise taxes, especially on corporations and high-income earners. A broadening of the tax base, reducing loopholes, and implementing a more progressive tax system could help increase revenue without stifling economic activity. However, any tax reform must be carefully structured to avoid undermining economic growth or hurting middle-class families. Investing in growth is equally important. While reducing the debt is essential, it is equally critical that the U.S. continues to invest in the future. Strategic investments in infrastructure, technology, and clean energy will not only boost long-term economic growth, but also create jobs and reduce the economic burden on the future. Research and development in cutting-edge industries, such as artificial intelligence, green technologies, and biotechnology could help drive the U.S. economy forward and create a more sustainable fiscal path. Lastly, addressing military spending will be essential for controlling the deficit. The U.S. spends more on defense than the next 10 countries combined, and while national security is paramount, the military budget has grown unsustainably. By focusing military spending on modernization and reducing inefficiencies, the U.S. can cut costs without jeopardizing its defense capabilities. To address the growing national debt, the U.S. must take a comprehensive approach that includes a mix of spending cuts, tax reforms, strategic investments, and military budget adjustments. The country can no longer afford to rely on borrowing to sustain its financial system. While the solutions will undoubtedly be difficult and politically charged, the long-term stability of the economy depends on them. If the U.S. can balance fiscal responsibility with growth, it will not only secure its financial future, but also lay the groundwork for a more sustainable and prosperous economy for generations to come. The key to navigating the national debt crisis in 2026 will lie in the government's ability to reform entitlements, raise revenues strategically, and invest in future technologies and industries. The time to act is now, and the future depends on making the right choices. In 2026, the U.S. will be at a crossroads. With a national debt projected to exceed $35 trillion, the country faces significant risks, from rising interest payments and potential credit downgrades to economic stagnation and diminished global influence. However, this crisis also presents opportunities. By making smart fiscal reforms, increasing revenue through targeted tax policies, reducing inefficiencies, and investing in future growth sectors, the U.S. can navigate this challenge and ensure long-term economic stability. The road ahead will require tough decisions, cutting programs that have long been politically sacred, raising taxes in a way that doesn't harm the economy, and addressing military spending. But with the right strategy, America can turn its financial crisis into an opportunity for renewal, just as it has done in the past. The key will be finding a balance between immediate fiscal restraint and long-term economic expansion, creating a roadmap for the future that ensures prosperity while managing the debt.